Well, today is the day the inflation data came out. It's still pretty hot, but no worries because the Federal Reserve has us all figured out. Inflation is not going to be something that you're going to be worried about because severe recessions destroy inflation. That's right. Recessions kill inflation. That's what the Federal Reserve is going to do. They're going to get a severe recession going here in the United States. It's going to be a global one, but it's going to kill inflation. Now, you're probably going to have trouble with your job. Your business is going to struggle, but I'm going to tell you inflation is certainly coming down, and I'm almost positive we have another 1, 2, maybe 3 more rate increases coming at us just to make sure that all this inflation is going to die. Let me go to a couple of these slides and let's just talk about this because we no longer going to be worrying about recession. You're going to be worried about your job. So let's just talk about what's going on right now. Now, here's what we got today. Headline CPI at 8.2%. Now, this is looked at many different ways. This is what everybody's talking about is the CPI headline number of 8.2%. That's pretty scary. However, I do want to bring this to your attention. This is coming down just a little bit here. So as you know, I've been talking that I think that the inflation is going to moderate. I think it's certainly starting to moderate. We'll go through a couple of charts just to prove what I'm talking about here. But this is starting to kind of drop down a little bit. Still too high for a lot of people. But I think what we're going to find here is that inflation is coming down. Now, how far down does it have to go? Well, they want to get it down to 2%. They unleashed the genie out of the box by $4 trillion or 10, oh, I guess it was $10 trillion. Wasn't it $10 trillion? What did you expect was going to happen if you let loose with $10 trillion? The sad thing about that is we didn't build infrastructure, we didn't build ports, we didn't build super highways or bring in more internet. We just wasted this money, gave it away, and we've got really basically nothing but inflation for our efforts. So let's go to my next slide. This isn't going to be a long one. And here is the theme. It's demand destruction. So inflation, you can either have supply and demand. Now, you can either bring in more supply to get prices down, or you can destroy the demand, and that'll get prices down as well. Oftentimes, we're in equilibrium. We have enough supply to match the demand. That's a perfect world. But of course, we had all kinds of constraints. We had COVID where we were closing things down. We had ports where we couldn't bring in super tankers and container ships, couldn't bring raw goods in. And of course, we got a huge pent-up demand. And now what we're going to do is destroy that demand. Now, when you destroy the demand, you do destroy the economy. Your livelihood probably is going to be at risk. So you really need to start thinking, how am I going to protect myself? What am I going to do? Now, this isn't going to last forever. And it's going to lead to some tremendous opportunities, just tremendous opportunities. So if you're in the markets and you've seen your stock portfolios and bond portfolios really take a tumble, there are lots of bounces within recession. We're going into a bear market, I think is what they call that in the equities market, and they don't go straight down. You have some really tremendous rallies and bounces within a bear market, and you're going to have an opportunity to make some money or lighten up your portfolio. So things aren't that bad. So let me go to my next slide. Let's just talk about what's going on here. Now, again, this is what we're talking about. Now, my last video, we talked about the severe recession was coming. So I just stole this slide from that one. If you want to take a look at that last one, go back to my YouTube video last week, and you'll see what we're talking about with severe recession and the case that we've made for that. By the way, if you like my videos, give me a thumbs up. Subscribe really helps with the YouTube algorithms. And if you have any comments or thoughts, put them on there, and we'll talk about that. I'll try and respond to them so we can really because I don't say I have all the answers. I may have some of the answers, but what you're experiencing may be different than what we're experiencing. Now, I took this from the Chicago PMI from the Purchasers Managers Index, and this is coming straight out of the Federal Reserve. They're the Fed district. And look at this. Their PMI dropped to 45.7, but it wasn't like a slow drop. This came right down. This just came right down, just plummeted. And on these PMIs, if it's over 50, you're in expansion. If you're under 50, you're contracting. Now, a lot of times we just spend right here, just a little over contraction. That's just kind of like the Goldilocks area, 52, 53, 54. We didn't get that from COVID. We just popped right up to unsustainable levels. Now, it was really to be expected that we were going to come down to these levels. And we stayed a little bit here between 56 and 60. This was really, 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 really good. We were getting a lot of this pent-up demand gone. But here in the last couple of reportings, you can just see where it has just fallen, like the bottom has fallen out. And of course, this is Chicago. This is the Great Lakes region. Fabulous manufacturing, fabulous industrial, great retail area. And this isn't unusual. You've got this going on in Dallas, you have this in St. Louis, you have this in New York. New York's really a huge financial hub, and they're also experiencing the same thing. So we're seeing business is really dropping like a rock. It's really, really coming down. So demand destruction is just going to be assured. This is what's going to happen. So when you have demand destruction, that means across all asset classes, across all businesses, that you have business slow down. So if you're in the medical field, of course, you're having a heart attack, you've got to go to the doctor. However, if you're having elective surgery, those things get put off. Your dental work gets put off. A lot of these things gets put off, so everybody suffers. And, this is just something that's going to lead to opportunities. But at the moment, we need to make sure that we're not overspending, we're not over encumbering properties, and we're buying at a very, very sound decision on that. Let me go to my next slide. Keep in mind, you are always welcome to talk with us. If you have any thoughts, we're more than happy to discuss them with you. Now, I've been talking about the fact that I thought that we were going to have inflation moderate. Matter of fact, if you go to my video with Charles Nenner, when he and I were discussing inflation, we do think inflation is going to be with us for a long, long time. There's a couple reasons for that. But we also talked about the fact we thought inflation was going to be moderating. I thought it was going to be moderating before this. I'm on record as saying I thought it was going to moderate. But look right here now, builders have just been going gangbusters, and they're having difficulty bringing product to market and finish it up because there's been supply changes. Now, if you look at this is what's going on. So this was kind of like the peak in the last year. This is what drove builders really became very, very cautious because lumber went up here to $1,464. And that was kind of like a record. It's a pretty high number. And of course, builders buy these things on forward futures. And they were very, very concerned because the lumber had tripled. Because you can see here, this was down, under $500, and it had built its way up to over almost $1,500. Now, this is where we are now. This isn't very long ago. So this is like 7 months ago, 7.5 months ago. And this is what's happened in the last 7.5 months. We've had interest rate increases, and they're really taking effect. But keep in mind, interest rate increases take 3 to 6 to 9 months before they start taking hold. So these are just now starting with the minimum increases. We haven't felt the full effect. And lumber is down to $497.30 today, the 13th. So you can see it's dropped 60%, 70%. So you can see where the prices are certainly coming down. This is good for the builders. This is really, really good. I mean, the cost of construction, of course, with lumber is a huge component of this. Labor certainly is too. So we're going to talk about labor too. But let me go to my next slide. Let's just talk about that one too, because I think that one is wheat. And this is the continuous wheat. Now, it hasn't come down anywhere near as radically as we have with lumber. But again, here May 19th of this year. So that's what, 4 months ago? Uh, yeah, 4.5, 5 months ago, 5 months ago, it hit 1277. And here we are today at 891. So it's down 25% probably and heading down. So we're starting to see this. Now, a lot of this has to do with the Ukraine war. And again, keep in mind, this is fungible, which means that it's used throughout the world. If it's a grade A wheat, you can buy grade A wheat in Ukraine, you can buy it in Australia, you can buy it in Kansas, and that's an international number. Keep in mind, it's also a U.S. dollar. It's expressed in U.S. dollars. So if you don't pay in U.S. dollars, it's really expensive for you. That's why you see euro is having huge inflation. It's one of the reasons that they're seeing it. Same with Great Britain. If you're in one of the emerging markets like Indonesia or Japan, not Japan, but Taiwan, or when you get into Vietnam or all across Africa, where their currencies are really kind of soft, it's even more expensive. So not only do you have a commodity push, but you have a monetary push as well. We don't have that in the United States, so we've been very, very fortunate. So that's been really, really good for us. So that's really, really good. However, it's one of our other themes too, why we'll continue to have some inflation and maybe better inflation, is that our US dollar is almost at an all-time high. I mean, it's like 113 on the DXY. That's pretty high for that. We could go to 122. We've been to 122 before, but typically we run around, 90. But what if we go down to 72? We've been to 72 as well, because everything cycles. Dr. Nanner talks about everything cycling. If we're at 113, we're not going to stay at 113. We're going to drop from there. Everything cycles. So what happens when everything's expressed in US dollars and our dollar drops? That means we're going to be paying more for everything, and I think that's why we can have some inflation. So let me go to my next slide. Now, we've got all kinds of charts coming out here, so I want to tell you that we've got the PPI, we've got different ways that they're expressing this, and they've broken it all down as to what segments. So here's something you need to be concerned about. The PPI, Producer Price Index, this is where it starts. This is where all those fungible things come in. It's like when you get wheat coming in and the price of wheat goes up, that's going to affect bread everywhere, because as it comes into the millers and goes into the mills, it comes in at the producer price level. And everybody that touches it is adding inflation to it themselves because their costs are going up. And so there's a multiplying effect. Now, it was almost 12%, and that was just a couple of reporting periods ago. But now it's come down to 8.5%. So that's a 25% drop. That's a very, very good sign, and that's from the PPI. And this is September. I expect it to be even lower when we get to be into October. But nonetheless, this is a pretty sizable level, 8.5% at the groceries. We talked about that. If you look at my prior videos, it's brutal at the grocery level. So let me go to my next slide. So now they break it down into lots of different CPIs. This is one that they're concerned about because it's still rising at 6.7%. That's this green line, and that's kind of the services. And that's calling plumbers and electricians and workers, and workers have been going up. So it's been getting better. However, a lot of the commodities, again, we just talked about that with like food and flour and fuel. Oil has dropped. So yes, we have some things coming down, but the services, and we use a lot of services. I mean, this is something that you and I do. I mean, if you get your refrigerator fixed or washing machine fixed, or someone comes over to fix your roof, those are services. And I'm in the services. I'm in consulting, and we're in the real estate business. Our services are still fairly expensive. So, and those are still rising. So we need to just be concerned about those. Let me go to my next slide. I think they're going to moderate again as well, but again, it hasn't happened yet. Now, if you go to my other slides, I'm going to tell you that we're still looking at food at home, and this is where a lot of us is. Remember, we had 8.5% down from 12% on a producer price index for food. So grocery stores are still pretty high. We talked about inflation at the grocery store being 15, 18, 20%. And it came in at 13%. So that's pretty high. That's brutal. I do think it's starting to peak. If you just look here, remember we're always lagging, so a lot of our information is lagging. But I think this is starting to turn. Now it's certainly bears that we need to keep our eyes on this and see what's going to happen with this. But it looks to me like we've got some at least it's moderating. Hopefully, it's moderating. But it's like food and gasoline and rent. I mean, this is what everybody feels. I mean, when your food's going up and electricity's going up and your gasoline's going up and the landlord's calling you saying, "Hey, my food and electricity's gone up. I have to raise your rent." These are the things that we really, really feel. You're not so much worried about gold and copper and aluminum and things like that because it's not in our wheelhouse. But you do feel electricity, you do feel gasoline, and you certainly feel food. And if you've been out to any kind of restaurants, you know what's happening on that level as well. So let me go to my next slide here, and let's just talk about that. So we talked about food and shelter. Now we're still showing on our index that we're having an increase in rent. Now remember, this is one of those basics. So food, water, shelter. So it has been going up and rising very, very significantly. This is why in our investors, we say that if you buy rentals, they are an inflation hedge because you can see as inflation comes in, price of rent goes up. And that's really, really good for investors, particularly baby boomers around, I have retired from their incomes. They need something that's going to protect their purchasing power. Great for us, very bad for tenants. That's why I've been saying that you need to purchase a property. First-time home buyers are going to get an opportunity here in the next few months to do that. I think you really need to think about that. Certainly, be conservative in what you're doing. But when you look at this is a 6 to 9 month lag on this. And look, what's this? I got this morning from Redfin. So this is very current. So sometimes, our data takes a while to get in. So this is last month's, and we're going to tell you here in Metro Phoenix, we're starting to see prices kind of moderate a little bit. And on a national basis, we're starting to see some easing that's coming in. Now, again, once you get into a recession on the rental business, you have three grades of rentals, A, B, and C. A being the very best, the newest, the brightest, the nicest. When you start having economic trouble, people migrate from the upper end to the moderate end. So they go from A to B and B to C. Now, this could be part of what's going on. So those people that are in the penthouses are moving out of penthouses and coming down. And of course, they're not paying so much in rent. And there could be another reason, and I'll go over that with you, in that I think that as we get recession, as we get inflation under control and prices are stabilizing, however, interest rates have gone up to 6 and 7%. You're going to have fewer and fewer homes sold. So that means that there's less and less movement in the marketplace. Now, in my business, when we have a turnover, and that means that someone's moved out of our property, we have to go in and paint and clean and remarket the property. We have some costs, and we bring that property to market rate. So had someone been paying $1,600 a month, the market's moved to $1,900 a month, we would take the full markup to $1,900, and that's on movement. Now we don't do that with our tenants that are living with our tenants. We try and understand that people use our rentals as their home. So we want to make sure that we try to be as understanding of that as we possibly can. And we want them to stay. We want them to put down roots. So we always moderate the price increases. So less movement, less rent increases on a existing portfolio. So I don't know if that's too esoteric sometimes, but that's also, so less movement, you're going to have less rental increases as well. Now, here's what we've been talking about. It's an absolutely outstanding time if you're a worker, if you're a skilled worker, if you're a roofer or a plumber or an electrician, you want to do side work, you can talk to your boss and just negotiate better wages. This is just a great time to be doing things on the weekends. You can really put some capital together and prepare for the coming opportunity that's coming. However, if you're not paying attention, your wages are being destroyed by the inflation. So, yes, we have a 5% wage growth, but we're in an 8.8% inflationary period. That means you actually lose 3.8%. And that's been going on for 18 months in a row. So, again, if you're not inflation hedged, you are just in deep trouble. And we've been trying to hammer this home. Wait until the US dollar starts to drop. This is going to accelerate and become exasperated. So, you need to get something that is going to be an inflation hedge. It's just going to have to happen. I know it doesn't seem like this is what you want to do, but it's something that you need to do. So let me go to my next slide. I want to try and get closer and finish this up. We still have some good things in the marketplace, but the economy is starting to slow. You can see this in our new orders. You can see this in a lot of the manufacturing and the industrials. They're starting to slow down a little bit. We did get a surprise in that we're getting some rebound. And I'll tell you, we've got a war going on in Ukraine. Anyone that's with the defense industry is going to be getting new orders for that. That's going to rebound in their favor. So we do have that. And here I'm going to tell you this is automatically going to increase and justify the Fed increasing at the next meeting between the inflation headline number of 8.2% and then this last week's employment number for September of 262,000 jobs. It's just going to guarantee that we're going to get another rate increase. It might even become a full percentage. So you just have to protect yourself from that. So how do you protect yourself? Well, you have to really get out of debt. If you're in debt, you need to get out of it as quickly as you possibly can because you're probably paying interest on it. And that interest is going to go up. And if it's an adjustable rate interest, you really have a double whammy. So you really need to get out of debt. That's probably one of the greatest things that you can possibly do. Get an extra job, get a weekend job, work at night, get 2 jobs and try and pay these things down and try and put together a little nest egg for yourself. I would say, rethink all your spending. If you've got a TV and you go over to Costco and they've got that big, beautiful one, maybe you should put that off for just a little bit. Wait till it comes down in price because it's going to come down in price. It's going to do that. So I would rethink my spending, and I would rethink my savings and save as much as you possibly can and get out of debt. So let me go to my next one. And let's see if we have any other words of wisdom for you. And the thing I'm going to tell you is that, yes, it's going to be very, very difficult for the next, 8 to 12 months to 18 months. If they really, really decide that they're going to raise rates to the ceiling, we could go 24 months, in which case it's going to be really, really tough for 24 months. But then we're going to get a huge opportunity. And I'm going to tell you, in between this, you're going to have huge bounces. Now, I'm anticipating one in the real estate industry coming very, very shortly. I think within the next couple of months, we're going to get a decrease and a backup in rates. So rates come down a little bit, and I think that's going to spark some buying. People that have been wanting to get out and buy can. So if you're a first-time home buyer, you're going to have a huge opportunity with which to do that because you've been priced out of the marketplace. You're not only are you getting better pricing, but you're probably going to be able to get some concessions from the seller, and there's a whole lot more selection. So great opportunity for you in the real estate business. I think it's coming right at us very, very quickly, and that's going to spur a little bit of more movement in the marketplace. So for as investors, I think we're going to be getting a little more price increase. Unfortunately, first-time home buyers, I don't see rents plummeting. I don't see rents dropping too terribly much. I think it's more of a statistical and just kind of a situational decrease in softening in rental market. I don't think it's much beyond that. Typically, even in severe recessions, rents hold up very, very well. The other opportunity I see is that if we get a backup in rates, that means bonds are going to get a little better. In which case, if you have a bond portfolio, you'll be able to talk to your investment advisor and decide if this is good for you to maybe sell or lighten up on some. Maybe you should pick some short ones up because I think the 2-year is right around 4.5% or 4%, 5%. You can get a fairly good rate of return for yourself. And the same thing with the equities market. Nothing goes straight down. and I'm sure we're going to have some bounces. So again, work with your financial advisor and decide if is this a trading opportunity for myself, or maybe if I'm overweighted, I should be able to get rid of some of these things and move into cash or a different asset class, maybe some real estate for yourself. We're here in Phoenix, Arizona. The future for here is just literally unbelievable. So we actually welcome a little bit of slowdown. Gives us better pricing for my investors, but long term here, this is going to be a sight to behold. So I would highly recommend that you talk to us. I mean, that'd be great. So speaking of talking to us, I'm with Creating Wealth is the name of my firm. I am with West USA. They're a $5.5 billion firm. They do our back office, they do our compliance, they do our paperwork and accounting. You're welcome to reach me through their switchboard. You can reach me at michaeldeville0@gmail.com. If you'd like to talk to me about any opportunities, about some portfolio building, you want to talk about retirement, we're more than happy to work with you and your financial advisors. We are fully expecting we're going to be getting some foreign capital coming in. And if you are in Germany or Italy or Turkey or Taiwan, any country, we are 100% set up for complete passive investments. We'll acquire the properties for you. We do have a buy protocol that was very, very strict with, and this gives us very, very good properties, and they cash flow. So if you want to move some capital here to the United States, you'll earn U.S. dollars in cash flow, and they're your properties. You own them. We just will take care of them for you. We'll do absolutely everything. We'll buy them for you. We'll get them repaired, and we'll get tenants. We'll send you a check each and every month. Now, if I can help in any way, I am here. You're welcome to reach us. If you like my video, give me a big thumbs up, subscribe, and a couple of comments. My best to you.